Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome back to the show, John.
Hi, Jim. Good to be back.
Yield curves in the U.S. are flattening. Why is that news that we should be very aware of?
Well, the yield curve is the difference between long-term and short-term interest rates. And a positive yield curve, that is long-term rates that are higher than short-term rates, is good for the banking system. That's a healthy environment because it means banks can lend or borrow money short-term at low interest rates, lend it out longer-term at higher rates, and make a profit. When the yield curve starts to flatten, though, in other words, when long-term interest rates start to drop towards short-term rates, or short-term rates start to rise towards long-term rates, that's hard for the banking industry. If they can't get a nice big spread on their loans, then they don't make any money, and that's traditionally a harbinger of a slowdown. If you go back through history, you see when the yield curve in the U.S. drops from around 3% to slightly negative, in other words, when short-term rates actually get higher than long-term rates, a recession follows within a year. Now, we've gone lately from around 3%, with the 10-year Treasury being 3% higher than 2-year Treasuries, down to about 1%, and the descent is steepening. So if it drops much further, then that is sending a signal that we're headed for a recession. And there are very few instances of that not working, because it's an inverted yield curve where short rates are higher than long rates is a sign of really tight money. And really tight money tends to lead to a slowdown. So that's something that definitely bears watching. Another thing that's happening that is sort of in the same category of early warning signals is in the junk bond market. Junk bonds are money that people lend to basically crappy companies, or companies that for whatever reason have to pay a high interest rate in order to get you to lend money to them. In good times, when money is really plentiful, junk bond borrowers do fine because they can borrow from anybody. So if they have one set of bonds coming due, they borrow money from somewhere else, pay off those bonds, and life goes on. And so junk bonds are good investments. But when money starts to tighten, the first thing people do who don't want to lend money anymore because they're nervous is cut off the junk bond borrowers, because they're the riskiest borrowers. You cut them off first, but you continue to lend to Google and IBM and Apple and whatever because you're not worried about them. But the junk bond guys suffer. We're starting to see that now. Junk bonds are falling in price, rising in yield, and some new issues have been pulled lately. In other words, people tried to sell junk bonds, couldn't find any buyers, and they pulled them off the market. Here again, that's a sign of tightening credit. And if it goes on much further, in other words, if there's actual turmoil in the junk bond market instead of just a brief contraction, that's a sign that a recession is coming too. So an inverted yield curve or a tightening yield curve, at the same time there's trouble in the junk market, implies that credit is getting tighter in the U.S. Money is harder to borrow, and lenders are more and more discriminating than they used to be. So that definitely bears watching if if you own a big, for instance, stock portfolio, stocks tend to behave like junk bonds in the aggregate. In other words, they're like low-rated debt, the equity of a company. So if junk bonds start behaving badly, usually that coincides with equities behaving badly. So we could see trouble in the stock market flowing from the stuff we're talking about happening now in the credit markets. So again, none of this is definitive. It's all early stage. But it's definitely something that in previous cycles, people who weren't paying attention to this kind of stuff wish they were eventually, because they end up getting blindsided by an equities bear market.
Now, you'll recall about a year ago, Janet Yellen, the head of the Fed, said we shouldn't expect a financial crisis in our lifetime. And, I mean, I don't wish bad on anybody, but does she secretly have terminal cancer?
Yeah, she must be thinking her lifetime is very short, or all of our lifetimes are very short. So maybe she knows something about an alien invasion or something that we don't know about. But financial crises are a normal and natural part of a capitalist's relatively free market financial system. You know, they're like forest fires. If you were to say, well, there will never be a forest fire again because we're managing our forests so wisely, that kind of guarantees a gigantic forest fire out there at some point, because you're not letting the smaller forest fires come through and burn up a lot of the underbrush that would make a fire a very bad fire if it's allowed to build up too much. Same thing in finance. You know, if we go a long time without a financial crisis, then so much bad paper and stupid investments and corporate malinvestment tends to build up that the eventual crisis is much bigger and nastier than it would have been if we'd had some mini crises along the way. Now, we're in the midst of one of the longest expansions, in other words, the longest periods of time without a financial crisis in history. So I think it's a pretty safe bet that Janet Yellen is not just wrong, but diametrically wrong. You know, she is 100% wrong, because a financial crisis is guaranteed, and the longer we put it off by manipulating markets and pushing interest rates down to unnaturally low levels, et cetera, the bigger and nastier the crisis will be when it hits. So I think it's a fairly safe bet to take anything that comes out of the mouth of a Fed governor in the U.S. as completely wrong, and to do the opposite, because these guys are just historically terrible. You know, you can go back through the collected statements of Alan Greenspan and Ben Bernanke, and it's shocking how wrong they are at big turning points. You know, these guys just did not get what was going on in the markets that they were supposedly controlling and managing.
And you know what I find
the idea that Janet Yellen is completely wrong when she says something is consistent with history. unless she's a lot smarter than her predecessors. She is also clueless, and whatever she says definitively is going to turn out to be completely wrong.
And what I find ironic is that those same people who horribly misjudge these economic downturns are given massive speaking fees to talk to us about, and I'm sure they say, I was brilliant. They don't talk about the mistakes.
No, they talk about how courageous they were by forcing down interest rates and creating lots of new currency, as if that's hard work. You know, to create money in today's world for a central bank, it takes typing a number and hitting send, basically. That's all the work that's involved. And creating new money and giving it to people is the least courageous thing that anybody in the world could ever have to do, right? Because everybody you give money to is grateful. They all think you're a genius because they all think they deserve the money. So yeah, you know, Bernanke and Greenspan go out and make these incredibly lucrative speeches where they say nothing, but they get paid a lot because, you know, it's basically a case of confirmation bias. They stand in front of Wall Street brokerage houses mostly and tell those guys what they want to hear. And the brokerage houses give the speakers what they want to receive, which is lots of money. So it's a great deal all around. And it's going to be historians who have to set things straight. You know, the books that are written 20 years from now are going to portray Ben Bernanke and Alan Greenspan as absolute villains or total buffoons or some combination thereof, because they're going to have hindsight with which to judge what the central banks of the world have done and the governments of the world have done, and it's not going to be pretty, because the ultimate conclusion to all this hasn't happened yet, and it's going to be brutal when it does happen, because we continue to borrow insane, accelerating amounts of money on top of historically unprecedented amounts that we've already borrowed over the past 30 years. Jim, let me give you one example of something that's happening in the U.S. right now that historians will have a field day with. Chicago has mismanaged its pension plans. In other words, the plans through which it pays retirement benefits to its teachers and cops and firefighters over the past few decades. And those pension plans are now about $36 billion in the hole. In other words, they need $36 billion more dollars than they have at the moment in order to be able to cover their bills going forward. And that's a lot of money for one city. Think about that, $36 billion. And they continue to have to borrow more and more money because they don't put enough in. They can't raise taxes to a level that would allow them to fund their pension plans, and they can't cut benefits because they're legally obligated. This has been tried in the courts, and the city trying to cut benefits has lost. They're not allowed to cut benefits. So they're basically stuck. If they raise taxes, everybody moves out of Chicago and their tax base collapses, which that's kind of happening right now already. If they try to cut benefits, they just lose in the courts, and that's that. So what they're doing is they're securitizing some future income streams. Right now, the state of Illinois collects sales taxes and sends some of it back to Chicago. That's guaranteed money coming in, basically. So what Chicago's doing now is creating a securitized bond offering, which receives that money that now goes to pay all of Chicago's bills. Now it's going to go to pay the creditors who buy this one batch of bonds, which are rated AAA, because they have guaranteed money coming in to cover their interest expense. But that means the people who lent Chicago money in the past are now even more guaranteed to be stiffed because they don't have access to this money that used to come in and help pay the interest on existing bonds. So Chicago's other bonds are going to fall further and further into junk territory until Chicago, one way or another, defaults. They really don't have a choice in the long run except to just stop paying the interest on their bonds and then declare bankruptcy, and in bankruptcy court cut the benefits of all their plan beneficiaries. That day is coming because the numbers flat out don't work, but Chicago is doing this crazy thing where they're securitizing basically a crown jewel. They're selling off a crown jewel of their financial situation to bondholders in return for a little bit of money right now that won't do them a bit of good in the long term. It buys them a year or two of muddling along before they collapse, but that's really nothing in the scheme of things. And that is kind of illustrative of what everybody's doing in the U.S. You look at every level of society, we're all making choices like this, where we use debt or something like debt to get us through the next year or the next corporate reporting cycle or the next election cycle. And then we worry about what's going to happen after that. We let our successors take care of that because most of the people making these decisions are in their 50s and 60s. In other words, they're going to retire pretty soon. And if they can just get through the next few years, they become Ben Bernanke or Alan Greenspan. They retired with the system in at least not bankruptcy, so they can go out and criticize their successors' decisions and make speeches for money and collect a really, really nice pension and be prestigious and be perceived to have been successful in their careers. That's what they're hoping for right now. Historians who go back through the records and figure out who did what are going to be really hard on these guys. But it's only their children and grandchildren who are going to suffer by seeing their ancestor pilloried in history books, because those guys will be dead and gone by then. But that is the way it's going to play out. We're creating a lot of Herbert Hoovers, people who are going to be blamed for stuff, but only posthumously. Only after the fact are we going to find out how stupid and short-sighted these people really were.
We'll have more with John Rubino right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Welcome back. We're speaking with John Rubino. John, the Russian government has created a crypto ruble. Everybody's saying you got to get into Bitcoin or you're going to miss the boat. But our government's going to sit back and just let cryptocurrencies run the world.
Well, cryptocurrencies is a tough one because it's brand new conceptually. Nobody knows how this is going to play out. And it's not clear what the right response from the point of view of a government is. It's not clear whether they're good investments. It's not clear whether they're actually money yet. And they might be all of that. They might be a financial asset. They might be cash. They might be eventually doing all the things that money does. A store of value, a medium of exchange, a communications medium, all that. But we just don't know yet because they're so brand new. And different governments are responding to them in different ways because they might be a threat to today's fiat currency / fractional reserve banking system. They might take away some of the power that governments and banks now have over basically the entire economy. And no government will let that happen if they can think of a way to stop it. So you're seeing governments respond in lots of different ways. One of those ways is to try to regulate Bitcoin and the other cryptocurrencies out of existence. The U.S. is kind of flirting with ideas like that, and China has gone a lot further. They've made initial coin offerings illegal, and they're closing down Bitcoin exchanges. Japan, at the other end of the spectrum, is kind of open to the idea of cryptocurrency, and they're on the way to making it a legal tender there. Russia, as you mentioned, might just start its own cryptocurrency and presumably make the other ones illegal, but have a kind of a crypto ruble that functions like Bitcoin, but is legal tender and controlled by the government, so they can still have all that power over the economy that comes with the ability to create new money out of thin air. And I don't have the slightest idea how this is all going to play out because, again, it's all brand new. And a lot of people are making decisions out there with limited knowledge of the concept and the future direction of cryptocurrencies. It's fascinating to watch. The idea of private sector money is near and dear to libertarian hearts. So from that point of view, a lot of people with the political philosophy that I am most attracted to find cryptocurrencies a great idea. There are other people who see it as possibly a means of control for governments over people because the NSA and the other spy agencies of the world presumably can monitor all of our Bitcoin transactions and also presumably hack Bitcoin wallets and Bitcoin exchanges and maybe even interfere with the blockchain technology that controls transactions in cryptocurrencies. We don't know how this is going to play out. So it might be a force for freedom. It might be a means of control. It might be a threat to the fiat currencies of the world, or it might be something that's co-opted by governments and actually increases the power that flows from having fiat currencies. There's no way to know. It's very interesting. Bitcoin is soaring in value right now, as are a lot of the other cryptocurrencies. There's more coming to market all the time. And it's possible that the increase in supply in the aggregate of cryptocurrencies is really inflationary. We'll have to see. But as the aggregate value of the cryptocurrency complex increases, that's a financial event. It's like junk bonds rising in value, or tech stocks, or something like that, and that's inflationary. When an asset category goes up by 1,000% or 10,000%, you got to take that into account when you're looking at actual inflation in the market. The governments don't take it into account. They don't include asset prices in their consumer price indices, which means they miss the whole asset inflation thing that they generate in every cycle. So you can't count on the consumer price index to tell you anything about what's happening in the asset markets and the impact that something like cryptocurrency has on the real rate of global inflation. So, Jim, all this stuff is new. In 5 years, we'll know a lot more. Right now, it's basically a lot of people spouting opinions that they seem to think are absolutely true, undeniably, obviously true. But I think in retrospect, a lot of those people will be wrong, about one thing or another.
And people have already lost fortunes because their hard drive crashed and they don't have any other records of their cryptocurrency account.
Yeah, that's kind of analogous to storing a bunch of gold coins in a part of your house and then forgetting where you put it, something like that. It's possible to screw up and lose all your Bitcoin. And it's also possible to put it online and have that wallet or exchange be hacked. And that happens all the time. People lose money or lose Bitcoin all the time when exchanges get hacked, or when the people running the exchanges just take off with the money. A Bitcoin account is not FDIC insured. And in that sense, it's like if you store some gold with, GLD, the big gold ETF, that thing can go bankrupt in a heartbeat and you could lose everything. So it's like a Bitcoin exchange. And people learn through their mistakes with stuff like this. Every time some Bitcoin exchange gets hacked and people lose thousands or millions of dollars, that educates the rest of the market. So over time, we're figuring out what to do. Right now, I think a lot of people don't know, and that's going to come back to bite them.
We'll have more with John Rubino right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with John Rubino. John, are the people in the U.S. getting antsy about whether or not President Trump will be able to produce any tax cuts? And if he does produce these tax cuts, the U.S. government is already horribly in the hole. How is that going to improve that situation?
Oh, it's not. There's no magic tax rate that fixes a system that has debt equal to 3 or 4 or 500% of GDP. We're already so deeply in a hole that there's no way to dig out of it. All we can do is via some kind of a crisis resolve this thing by wiping out the debt via deflation or inflating it away. We can't fiddle around with the tax code at the very margins and get anything done. Now, having said that, that doesn't mean the tax reform of some kind won't happen, because it always happens. We have a new tax law every decade or so in the U.S., and the reason we do is not because the government wants to improve the tax code. It's because that's a means of extortion for them. That's how they make a lot of money to finance their campaigns. Because think about what it means to change a loophole-ridden tax system. Right now, everybody gets some kind of a tax break. We all have a loophole that we love and we don't want to give up. And then the government comes along and announces that it's going to close a bunch of loopholes and lower rates in order to simplify the tax system and make it more fair and make everything more efficient. Well, every single major entity that has a big tax loophole that it feels like it needs for its profitability then has to go to the government and figure out who to bribe in order to keep the loophole. So what these guys have done this time is they announced, oh, well, state and local taxes will no longer be deductible, and the mortgages on houses won't be deductible, and this won't be deductible, and that won't be deductible, blah, blah, blah. And what they're basically doing is putting out a shopping list for their big constituents to come in and pay them. If you are the Mortgage Brokers Association, Mortgage Bankers Association in the U.S., you got to protect the mortgage deduction, right? So you got to send your lobbyists with a bag full of cash to Washington, figure out exactly which votes you need to buy in order to restore the mortgage deduction to the tax code. And then you got to spend that money. And it's the same thing with everybody. Oil and gas and the auto industry and state and local governments, they're all in Washington right now giving money to the tax rating committee members. And those guys are banking it and then planning their re-election campaigns. So this is meaningless. And it won't amount to anything. That's my prediction. Because it never does amount to anything. And we will have a gigantic financial crisis at some point in the not-too-distant future because of all the debt we've taken on in the past. Maybe it's Chicago, which we just talked about, that blows up first and takes us down. Maybe there's a war in the Middle East. This Saudi Arabia stuff, Jim, is creepy, isn't it? Are you watching that? That could easily turn into a regional crisis that spreads.
Well,
and it goes on and on. There are all kinds of things going on in the world right now that could easily turn into something bigger, that could conceivably spread to the rest of the financial markets and then tip this, debt gorge system over a cliff. Or we could just see stock and bond markets tank like they usually do at 10-year intervals. We're 10 years in to a bull market now in stocks and bonds. Actually, we're 30 years into a bull market in bonds, 10 years into a bull market in stocks. We're at valuation levels that have historically preceded big crises. So there's no reason to think that it won't happen again. And if it doesn't happen again, it'll be because governments did absolutely crazy stuff to keep it from happening. And that crazy will come back to bite us some way otherwise, in a currency crisis or something else that we haven't given a name to yet.
John, thank you so much for chatting with us.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. If you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.